Welcome, everyone. My name is Rob Kahn. I'm from Climate Policy Initiative, and thank you for joining us today. Just before I hand it over to Bella Takanoji, who's going to be our moderator, just a few bits of logistics. We're going to have, Bella's going to do an initial presentation, then we're going to jump into our panel presentation and discussion. We request that everyone remain on, because we have so many people joining today, we request that everyone remain on mute during the presentation. After the initial panel discussion, we will entertain questions from the audience and we'll try to get to as many as we can. But because there's so many people joining us, please pose questions in chat, not verbally. It will just be too difficult to manage if people are chiming in verbally. So post your questions to chat. We'll be logging all those and we'll try to get to them as many as we can. And we are recording this, and the recording will be available after. And with that, I would like to hand it over to Bella.
Great, thank you so much, Rob, and thanks so much to everybody for joining me today. Really excited to see all the enthusiasm for the topic, and I think most importantly to hear from a really excellent panel today. So thank you again all for joining. I'm really excited today to be launching our work on scale and to be joined by this highly distinguished panel of climate and blended finance practitioners. Their blood, sweat, and tears over the last years are the reason that the analysis that we've done at CPI that we're talking about today is possible in the first place. So let me just start today with a brief introduction to our work in the lab and on scale, and then we'll spend the vast majority of the hour digging into the experiences and recommendations of our panel members. So I'll go a little bit over what we've done to date, why we did this analysis, and then we can dive in. So my organization, Climate Policy Initiative, manages something called the Global Innovation Lab for Climate Finance, which is an incubator of financial innovation for climate change solutions. The lab started in 2014 with the recognition that climate finance flows fall far below the investment needed each year to reach a 1.5-degree warming scenario. One of the implications of this is we need public investment to do a far better job mobilizing private investment. So the lab was launched by several governments and philanthropies to fill this gap, and specifically to identify, develop, and launch innovative finance instruments that can drive billions in private investment to action on climate change and sustainable development. And today, as you can see on the slide, we've incubated 49 solutions in collaboration with more than 80 lab member institutions from the public and private sectors. And these solutions have mobilized more than $2.3 billion to date. And just so you know a little bit what we're talking about when we talk about solutions, they tackle investment barriers in many sectors and across regions, mostly in emerging markets. And just to emphasize, we're not a tech incubator like most incubators you hear about. We're actually a financial instrument incubator. So we've helped develop bonds, insurance products, project preparation facilities, securitization vehicles, just to give a few examples. And now we've had a number of successes and of course some innovations that didn't make it. And now that we've been around for 6 years, we're starting to see a few of the earlier instruments that we worked with scale up. So that by that, I mean the initial teams are doubling down on the concepts and growing them. And we're also seeing concepts being deployed and replicated even by new teams in new geographies. But because the lab focuses on early stage innovative ideas and it's only been around for 6 years, the number of solutions that have reached scale or replication is a small part of our record to date. So as you can see on the graph in this slide, 240 million of the total of 2.3 billion mobilized that we've counted is actually due to the scale up of the solutions that have been piloted and that we helped to develop in the lab. We're running out of time to deploy climate solutions at scale. And so we started asking ourselves, well, what can we do to help make scale happen faster? And this project, which was kindly supported by lab funder Bloomberg Philanthropies, looks at that question. And our findings from the analysis that we conducted on this topic are available on our website. Rob should be posting a link to that page so you can check out that full analysis. So I'll just very quickly review the key factors that we identified in this analysis, and then we'll go into the panel to actually kind of hear directly from many of the practitioners involved what they think about it. So first, just to say, we focused on factors within an innovator's control, so not on broader systemic or policy change. And we identified factors by reviewing the lab's early instruments and combining that internal research with a review of literature on scale. And we looked at both development literature and entrepreneurship literature. So we developed these 4 success factors for scale. The first one, which is on your screen, is the most obvious. If you're going to scale, you have to prove your concept. The key here, though, is understanding upfront how you'll know when you've proven your concept and how to do that as quickly as possible. And I think for us in particular in the lab, we deal with a lot of long-term models. And I think that's true in a lot of climate and a lot of investment models. For example, a private equity fund might have a 12-year life cycle, or we might work with a forestry securitization model where the trees take 15 years to mature. So it's a long time to wait to fully prove out your returns and how everything has worked. So with track record, what we actually want to understand are what are the intermediate milestones that we can define and measure that'll indicate material progress. For example, for a private equity fund, it might be reaching first close and making your first investments in real projects. The second is finding economies of scale. So how do you consistently generate more impact per dollar invested over time? So for example, do you have to scale the whole thing, or can you take the core of it and replicate it at lower cost? Can you standardize certain elements like contracts? Can you reduce your marginal cost of acquiring pipeline? Third is the team and organization. And this came up a lot in the literature as well as interviews. Is it the right team with the right skill set and network? Does the governance model meet best practice? Will the project's champions stay to see it through? And on the latter point, I just want to underline that in each of the case studies we're discussing today, the people we've been working with have actually been the same throughout the last 5 to 6 years. They've been there from the start and have championed their initiatives and continue to make them better. Then fourth and lastly is partnerships, which are critical to any innovation. And for innovative finance, it's about having the right partners on board as early as possible, in particular for pipeline and for funders to help you lower your transaction costs. And my favorite example of this is actually from a colleague of ours at CPI who developed the Forest Resilience Bond in the US to reduce fire risk and restore forests. They actually started out with a plan to work with dozens or hundreds of small landowners in the West, and then realized if they could get just one organization, the US Forest Service, which owns millions of acres of land in the West, on board, they'd actually have access to all of that land with one partner. So it's more work up front, of course, but less so with every additional acre. So that's all I'm going to say about the paper. And please feel free to look it up online, and I'd love to receive your thoughts and comments on it either today or please feel free to email me after. But now what I really want to do is turn to the panel to discuss their own experiences. So let me just, before we dive into the panel, take I think Rob is going to post a quick poll. We were just hoping to understand a little bit better who is in the audience, also to help the panelists tailor some of their thoughts. So Rob is going to launch the poll now, so please do take a few seconds to respond.
I have terrible news.
Okay.
The poll disappeared.
Okay.
I logged in from the wrong device. I'm so sorry.
No problem, no problem. Well, we will then, we had a general idea from the registration list in advance. We have a lot of development finance practitioners, a lot of civil society. We had some academics, some folks from the private sector. So I think we can just go ahead and assume we actually have quite a diverse audience, and we'll ignore the technical difficulties. Thanks, Rob. So let me introduce, no problem. Let me introduce the panelists, and we'll go ahead and dive in. So I'm just going to introduce them in alphabetical order. So first we have Itzert Boersma, who's the Director for Partnerships for Impact at FMO, which is the Dutch Development Finance Institution. They've been a lab member since the beginning and have had key founding roles in actually two of the instruments you'll hear from today. Next, we have Aditi Gupta, who's Manager of Market Acceleration and Design Funding at Convergence, which is an observer to the lab, and they have provided design funding to a few lab instruments as part of their much wider and very well-known blended finance portfolio and research program. Then the remaining three speakers are entrepreneurs and intrapreneurs that have successfully scaled up climate finance instruments that all went through the lab in its early years. So we have Harold Hirschhofer, who's a senior advisor at TCX Fund, Andrew Johnstone, who's the CEO of Climate Fund Managers, who's the proponent of Climate Investor One. And finally, Maria Neto, who's a financial markets principal specialist at Inter-American Development Bank and the proponent of energy savings insurance. So just again, if the folks listening, if you have questions, please feel free to post them via chat, and we will try to get to them during the discussion that we are having now, which we're hoping to be as interactive and as interesting as possible. So let me now just turn to the panel and kick off asking everyone to come in with a couple of what we've called opening statements, just a couple minutes each to talk, I think, first from the instruments themselves. So Harold, Andrew, and Maria, about why you launched your instrument, what has been your pathway to get here today, just briefly so we understand who we're speaking to. Maybe we can start with Harold.
Very happy to do so. Well, thanks for inviting me and TCX to this webinar. And I just want to underline, I think, how important it is to learn about the experiences of in some instruments about scaling up, because I think it's all about scaling up. If we want to achieve the climate targets, we need to move from the billions to the trillions. And this is only possible if we scale up. So TCX has already been around before 2015. We were actually started in 2007. And then Barbara Buchner miraculously came to our offices at one point and said, look, while someone has proposed a long-term currency and interest rate risk hedging facility. And we said, look, we have been doing this in the microfinance and SME sector already. So we can also do it in climate finance. So let me explain a little bit what we are doing. We are a facilitating instrument for climate financing by offering instruments to hedge the currency risk. We effectively widen for developers access to finance, but we also, on the demand side for funders, we also help them to access the financing instrument, the projects which otherwise they could not because of the riskiness of the project. So we have this on both sides, on the demand and the supply side, this effect. We do not provide funding directly, but we work with funders like FMO to channel funding to these projects. So that's our role. And what our involvement with the lab did is that it really helped us to focus very much on understanding the climate finance needs. And we developed a number of steps after 2015, which made our instrument moving from a microfinance SME financing instrument to a climate financing instrument. On the one hand, we offered our hedging instruments for long term. So you can now effectively in all developing countries hedge currency risk up to 20 years, 25 years because of TCX. We have for the individual currencies volumes up to $300 million. So we can really be a solid and sound partner. The second thing is that we needed to learn a little bit about process innovation and what we could do there to support climate finance projects. One thing was the flexibility on our terms and the commitment periods which we offered. But also we learned that the type of instrument, our instrument design need to better accommodate climate finance needs. So we have launched recently, for example, a hedging instrument which is tied to the local inflation. We believe this is very, very important for climate finance in particular, because utilities or regulators often allow tariff increases be only up to the inflation change. And so by having these inflation index swaps, effectively funders can offer inflation indexed loans in local currency to these projects. And that was a very important step. We also, because of the lab involvement, we got access to a network of people who are interested in climate finance. And we brought on board not only the German Ministry of the Environment, but also DFID in the UK, and most recently the European Commission. They all want to support climate finance investments, renewable energy. And we have built this track record together with this network from the lab. Let me perhaps quickly also issue this topic. I really like your success factors here. Economies of scale is something, of course, where TCX is. We have 3 types of economies of scale, which was very important in our growth. And we grew from about 600 million capital to now 1.25 billion of capital. And we have 5 billion of hedging capacity. And this was due to 3 types of scale economy. The first was on diversification. The bigger our fund is, the more we can diversify our risk, and the more useful we can be, particularly for the bigger projects. We have a scale economy of network. The more people know about us, the better, easier it is for us to become a market maker of currency risk. And I will perhaps get to that later on. And the last one is, of course, scale economies of operations. And our team has not been growing very fast. We are very stable because we can effectively do quite a lot of additional work with more or less the same amount of staff. And that is very important for stability. And I think, as has been mentioned also earlier, to develop relationships with climate investors. And yeah, I think these network economies were extremely important. I want to stop here, perhaps.
Thank you so much, Harold. Very interesting. So let me just go right over to Andrew next to hear a little bit about your story.
Hi, Bella. Can you hear me okay?
Yes, yep. Very well.
Excellent, excellent. Well, thanks for inviting me today, and hello, participants. Right, so the story of Climate Investor 1 and Climate Fund Managers is a direct result of the Innovation Lab. The business and the idea didn't exist 5 years ago, and it was prompted by the first round of the Innovation Lab hosted by Barbara Buchner and yourselves in getting the whole thing going. So 5 years down the line, off the back of that stimulus, we are a business with just on $1 billion of capital under management. It's quite a large fund manager. We in excess of 60 people. And currently we have 6 projects in construction. And that outcome really speaks to what we've done. I won't take time explaining why. I think we're all climate enthusiasts and converts, so I didn't really explain the necessity for what we're seeking to do. But what might be of interest is actually how we're doing it and what we're doing. And what we are doing fundamentally is finding a way to increase the rate at which we deploy capital into investments, firstly. Secondly, we're trying to find a way to increase the amount of money we can deploy into investments. Those are the 2 primary objectives that we set off to try and achieve through our innovative financing design. And the way we try to get that outcome really was addressing two aspects. One was by addressing the risk profile of these investments and addressing risk from a slightly different perspective. And the second was speeding up the manner in which we deploy capital by simplifying everything. by removing friction points, and by removing it, money would flow quicker. Those were really the building blocks to what we're trying to do. To do that, we ended up doing quite a lot of flexing of what was already a well-established and tried and proven model. We started with the moving parts of infrastructure investing, project finance, infrastructure investing, and we unpicked that and reconstructed it. And we ended up with roughly 7 innovative components, which brought together what is now Climate Investor One and its manager, Climate Fund Managers. The first thing we did is we addressed risk in a different way. And we did so by using blended finance, such that risk could be shared between different types of investors in a structured way. We also divided risk into stages of life. A project during its evolution goes through very clear stages of life, different risk profiles that are acceptable to different types of investors. So we matched investors to different risk profiles. We also, the third thing is we went for scale. And the way we achieved scale was through blending. Get a large community of investors together, put them into a structure which they understand, and we ended up with 20 investors, which gave us a significant amount of money to deploy to get the initiative underway. The next thing we did was to address pace. We also simplified the instrument we invest through. So it's an equity fund, it's an equity investment, and it's a single check that goes and funds the project. So we try to destructure the complexity of project finance and just go on an equity financing route. The next thing we did is we tried to become much more active in the physical development of projects. So the business, Climate Fund Managers, is a bit of a hybrid between being an active developer of projects, an active equity investor, an active owner of assets, and we really do get involved in the whole cycle as an active deployer of capital to minimize the number of people who are required to deliver the outcome. That resulted in a big team. So we needed right from the very beginning to build a big team. And unlike other fund managers that grow progressively, we jumped in the deep end and went from 0 to 65 in about 2 years. And the final thing we did is to maintain momentum, to get scale as fast as possible and to grow that scale exponentially. We introduced the concept of recycling capital into the fund. So there's a lot of detail underneath all those 6 individual components, but each of them were specific vectors of innovation, which the lab enabled us to design as well as test the ideology with lab participants, and also gave us the momentum to actually get this underway. So for us, it's been a very interesting, a very invigorating and challenging ride thus far, but it does indicate to us that blending does work, and it certainly has got the potential to deliver on its dividend of scale and pace, which is what climate investing actually needs. Back to you, Bella.
Great, thank you so much, Andrew. Let me just turn right over to Maria for our last case study and let's hear a little bit about your story of energy savings insurance from the Inter-American Development Bank.
Thank you, Bella. For us, it's a pleasure to be here. It has been a pleasure all over the while we have been developing this instrument to be working with the CPI. Actually, the incubation and the support of CPI was extremely important, I think, for us in the replication of the model. The energy savings insurance was a product we developed initially in Colombia, considering the fact that, and I think is a characteristic at least of a lot of the economies in Latin America, the fact that there was a lot of potential for energy efficiency projects with SMEs, small and medium enterprises, but that these enterprises didn't feel comfortable to indebt themselves to borrow money for this type of investments because they had a lot of uncertainties about the returns of those investments. At the same time, lots of technology providers and service providers try to promote these technologies, but also with limited financial capacity to say, replicate what we call the ESCO model, for example, that works well, let's say in Germany or US. So we had this problem, and at the same time, financial intermediates that normally already consider financing SMEs a risky business, and with a lot of perception of those investments also being highly risky. So I think the interesting example here was that we were able to construct, together with a development bank locally in Colombia, Bancodex at the time, and an insurance, a private insurance, Suramericana, an insurance product that was going to be covering the energy savings performance. This energy savings performance allowed the SMEs seeing that with the insurance, they would have the security to be able to repay a debt in the case the savings would not occur. And at the same time, provided also more security for the FIs, for the financial intermediates, to actually reduce their costs of intermediation. So I think the beauty of the program was to create this, let's say, more trust in the market. And talking about, Bella, what we were talking in terms of lessons learned, I think the coordination and the collaboration was extremely important in this case. The learning experience that we started in Colombia, thanks to CPI and the lab, we were able to leverage this further in Mexico, and then with a regional program financed by the Denmark, many other countries. And further even replicated further with the Green Climate Funds in 3 other countries. So today we have in Brazil, Chile, Peru, Argentina, El Salvador, Paraguay, a number of countries in the region with very different conditions trying to pilot the program. Since we had the program in the lab and today, there's a lot of things that happened. I think the lesson learned we had was in developing and structuring this program, clearly a couple of things. You need to tailor it down to each country's situation. Standardization is crucial. The fact that we were trying to standardize more and more the workflows, the methodologies, the validation of the energy savings. We have been trying to collaborate with verifiers that help the metrics of the energy savings to be simplified so that the insurances, the SMEs, the technology providers, and the banks all can use these in better ways. But also we have been seeing that we are moving now to a moment where, at least in countries, let's say like the case of Colombia, the takeover by the insurance themselves of this product start becoming something very powerful. I will stop here since I know that we're going to have more time to discuss. Just to say also one beauty thing of the lab, and I think this is important, is beyond IDB to have been able to leverage this program ourselves, a number of other initiatives have used this product as well. A base in Europe is developing a replication of the energy savings insurance in Portugal, Italy, and Spain. And we also saw initiatives that are underway, for example, with Agence Française de Développement in Mauritius and in India. So I think the beauty here was not just only that we were able to scale up the instrument we developed, but that the instrument started also being taken over and adapted to other regions and other conditions as well. Thank you.
Thanks so much, Maria. And yes, indeed, I think your energy savings insurance has been a really nice example of how you can actually take the core of the product and others can replicate it. I'm not sure why the slides are up, but I don't think we need them. Let me turn over now to Itzert to speak to something I think that's quite interesting about FMO, which is that you've supported Climate Investor 1 and TCX from the beginning. So, you know, as an investor and as a development finance institution, how did you do it so right? Please give us, you know, a little bit of your secret or maybe not so secret sauce on how you evaluate for and encourage scalability in your investments and linkages across your portfolio. Thanks.
Thanks, Bella, and welcome to the audience, and also welcome to the other panelists. I think maybe on the why. So it's clear that there's a lot of financing needed to reach the sustainable development goals. And it's also very clearly that we're lacking. So it's not a question of why, it's a question of necessity to do it differently. So that's one. Second one is to look to different ways. So where is market failure? And then I think the role of development finance institutions like FMO and others should really be to bank on the network. So yes, we know donors, we know governments, but also we have clients that we finance on a daily basis. And we have linkage to, for example, pension funds or insurance companies. So I think nowadays it's really the key, the partnerships, where I think also the development finance institutes has to transform themselves from just bringing a loan. Everybody can do it over time, to really look to different ways of engaging. And I think also what you said, a kind of incubator ID, and if I go on Climate Investor 1, Andrew very eloquently outlined what he's doing. But I think it was indeed in FMO that it started, but it was also very clear that we could not do it on ourselves. So we lacked certain skills. So you have to be honest, not arrogant. And luckily, Andrew was willing to bring those skills. And then I think the second important point is then over time to let it go. So to let it go, to let it grow. So we had never be able to do what Andrew and his team has done if we would have kept it inside FMO. So the child grew up and flew away. And the same with TCX maybe 40, 50 years ago. The sheer amount of success that was just highlighted, that's amazing. And we could never have done it on our own. So that's the why and the how. And then I think very concretely replication. So I think we have to demonstrate those concepts work, as I think the various speakers have demonstrated, then be very open. So share what we have learned. Because I should be indifferent if FMO that does development banks course or somebody else does, because it's saving the world in the end. And even if I won't do anything, but can share the knowledge and also learn from others and make it in new products, that's exactly what we should do. Let's leave it here.
Great, thank you so much, Itzert. I love FMO sort of acting as an incubator in and of itself. I think it's just a great message for other DFIs in particular to hear. Let me now turn to Aditi, our last panelist, certainly not least. Convergence has been making a number of design funding investments, and you also do just a lot of really fabulous research. So I'm just curious, if the pathways presented in analysis we did sort of resonate with your approach and how you look at these topics.
Thanks, Bella, first of all, for having us here. It's great to be a part of this webinar. For those of you who don't know Convergence, Convergence is the global network for blended finance. We generate blended finance data, intelligence, and deal flow. On the market acceleration and design funding side, as Bella mentioned, we provide a market acceleration opportunity for practitioners to secure grant funding at the feasibility study stage or at the proof of concept stage to design and launch blended finance vehicles in emerging markets. And we have a number of different funding windows through which practitioners can apply. And our current portfolio also includes proponents endorsed by the lab who we feel are often at the right stage for the kind of funding that we provide, which is that some of the initial groundwork has been done, but there still needs to be quite a bit of work to get to where you can close and start implementing. In terms of the criteria we look at in our program, there are quite a few that's on our website, but scalability and replicability definitely form a key part of our criteria. At the time that we are evaluating, which is still at an early stage and the instrument is not fully formed yet, what we're looking to see is if the instrument as proposed takes off, can you scale it easily? Can you attract additional capital to it? Or can you use the same approach in a different market or in a different sector? Or is it something that has so much complexity that doing it a second time would probably take as much effort as doing it the first time? Then maybe it's something that's not right for scale and replicability. And I think also the demonstration effect is a key part, and I think also mentioned by some of the other panelists, which is what effect does it have on the market? Is it something that can promote a market-wide learning? Is it addressing a market failure in the market or attracting new kinds of investors? And looking at the paper, Bella, that you've put forward, I think out of the four indicators, I want to reflect on the team, which I think is a very key part of instrument succeeding and scaling, which is that the team is passionate, is bought into the concept, recognizing that at the time that the early stage support is given by the lab and by Convergence, there is a lot of time before it can reach implementation and probably longer before you can start scaling. And I think the proponents around the table today are a testament to the need for a strong team. And as was mentioned, also recognizing what skill sets are with the team and where they may need to form partnerships or bring in additional skill sets. I think that forms a really important part of scaling.
Thank you so much, Aditi. I think that's, I think what we've gotten up till now through these sort of opening comments is really a nice picture overall of how climate finance innovation, some of the most successful ones, have actually gotten to scale. What are the key factors in terms of simplification, of streamlining, of having the right team in place, having really the right partners in place, and coordinating and collaborating and doing things maybe the way, a different way that maybe hasn't necessarily been done in that way previously. So I think it's been very interesting to hear kind of how you guys have gotten to where you are today. I think the next question I'd like to ask is, what do you wish you had known sooner that you had to learn the hard way? And in particular, what could others, what could you have done differently, but also what could others have done to make your pathway easier? And we have an audience from, both from entrepreneurs, but also some of the stakeholders that are involved. And I just really want to get at where, beyond, in addition to what you could have done differently, or, what you've learned along the way, what message do you have for others as well? So let me turn, maybe we can go in the same order and start with the instrument proponents. Let's start with Harold. Maybe before Harold begins, we will take a round of audience questions after this. So if you do have a question, please feel free to put it in the chat. I see one already for ESI. Maria or ESIT, maybe you can even just answer that one in the chat itself, as I think it's a quite factual question. But let me now turn over to Harold to speak a little bit to lessons learned.
Yeah, I mean, the lessons learned, like I think you need to have the right business model at the very beginning, right? You need to have the economies of scale, and that was from our instrument for TCX as a market maker for currency risk, for exotic currency risk, very obvious. So we started out from a very strong position. What then the other elements of the secret sauce, perhaps to achieve successful scaling up and successful innovation, continue to innovate, is three elements. The first one is you need to be patient. It doesn't come overnight. I think one is always perhaps too ambitious. One has unrealistic expectations sometimes about how fast things go, how big it can grow, and you need to have very patient investors who understand that this needs to be built up over years. And we had great investors. So the other thing is trust, and there CPI Lab plays a big role, and I think if I can, I wish it would be even bigger in trust, because if you're a proponent of an instrument and you approach a government for blended resources or so on, you are, of course, you become more effective if you have an intermediary who's independent and who supports you, and trust is built over many years. So I think TCX has managed over the past years to build a lot of trust with funders and our shareholders. But for nascent instruments, that is very important. And the last element of the secret sauce is blended resources or concessional resources. I think we made sometimes the mistake that we thought if we can understand the value chain very, very well and separate the risks out and have specialized tools, that the need for subsidies or concessional financing falls away. That is not the case. Because if we want to mobilize a lot of resources in the higher risk countries in particular, in the low income countries, which poor institutional infrastructure, poor data, we need to have some type of concessionality. And even if you're the most scalable instrument, you need some type of concessionality to reach down to the lowest income levels. And because risk reflective pricing is very often it's not affordable still. So again, secret sauce, you need to have the right business model, you need to have patience, you need to have trust of our shareholders, and you need to have blended resources. And with the blended resource, we were very lucky because TCX had the German government, the Dutch government, the Swiss government, the UK government, and now the European Commission to support us. And we really benefited a lot from their support. And CPI also has been great in building that trust and deepening that trust when TCX was the new kid on the block in climate finance. We are not anymore. Thank you for that.
Thanks so much, Harold. Andrew, over to you.
Okay, so Harold stole two of my points, but I'm going to repeat them anyway, which is put a slightly different way. My top point was there's got to be a very strong common purpose, very, very strong common purpose that keeps the constituents and the community whose support you are seeking to marshal heading in the same direction, and the clarity of climate and the battle and the massive impediment that it actually represents if we don't win the battle is a very strong, very compelling, and a very focused theme that enabled us to marshal support around. And that's my interpretation of trust. It's the flip side of Harold's trust. And I think that if you've got a strong enough common purpose, then trust builds around that purpose. The second is you need very strong patient partners. From concept to revenue generation took us 3 years. Couldn't have been done just as a hybrid bunch of people. It needed strong institutional support, and FMO was key in that role. That whole period also cost money, so with that support, you do need a couple of $1 million in the bank to start something like this, or you need supporters around that who will provide that seed capital to get a business going. And it is money that goes towards starting a business, not making investments, but starting the business. The next thing you need is obviously deals. You can't get anything without demonstrating tangibility and credible tangibility to actually make investments. But probably the most difficult thing that for us was actually building an organization. Building an organization from start is not an easy thing. And the stuff that usually gets left off at the bottom of the to-do list, things like your financial systems of your organization, your company secretarial, the ability to actually convene, hold, record, and effectively make decisions, because you're going to make a ton of decisions. And these need to form part of the institutional library. They need to be codified, and all the stuff that ordinarily you don't consider because you want to rush out and do an investment. All the moving parts of building an organization that can operate at scale is hugely challenging. And what we had to learn through the blended finance was how to partner with different types of organizations. Blending by its nature brings public, private, philanthropic, development, all that type of capital into the same room. And they talk different languages. They move in different ways. They see the same apple from a different perspective. And trying to learn that multifaceted language so that it actually made sense to a much broader community was not easy. I think had I known one thing, which would have been useful to know 5 years ago, was just how difficult it is to develop a project. As a financier, we tend to be slightly removed from the actual cut and thrust of developing projects, but there are so many moving parts to developing a project. It's social, financial, technical, environmental, and any one of those things can fall by the wayside. And to get a new project done, which the future prescribes we do new projects. We have to do new projects, we have to do different types of projects because we need to address different challenges. And to get each of those new types of projects done requires resilience, it requires tenacity, and it requires an overwhelming purpose-driven initiative. And those adjectives I could attach as equally to the capital as I could to the people. It's all very well having all those evidenced in your team, but if you haven't got the capital that matches it, that is equally tenacious, resilient, and purpose-driven, or vice versa, you do have a disconnect. That has been our learning, to try and get those two characteristics evidenced in both the team and the capital, and then you have a formula that actually can achieve the outcome.
Thanks, Andrew. I really like the concept of tenacious team and capital. So thank you so much for that point. Maria, over to you.
I think I will start with the same argument on tenacity and a lot of patience. I think a lot of what we, hello? There is some interference. Can you hear me? Okay. Hello? Sorry. So I think indeed there are two things I think we learned. One is indeed that, as I mentioned at the beginning, we need to tailor the solution for each country's situation. Also, these results in having more patience on how to develop the program. A country may have, for example, let's say, as taking the case of Brazil, many insurances. Other countries could have one or two insurance offering this kind of products or products that could be adapted anyway. So the conditions also in terms of regulations or the standard contracts, the way we wanted to do, were very different from a country to another. So I think the tailoring to the countries ended up to be more complex than what we thought. At the same time, I think what we learned in the process is that we could simplify a lot what we had at the beginning. At the beginning, we, being more cautious, had a lot of, let's say, checks and balances in ensuring the quality, the verification of the savings and so on. And I think as we started learning and working in different countries, we also saw the advantage of having workflows or the methodologies, for example, for estimating savings, being standardized and actually used from one country to another. No? So probably I think one lesson learned is the need for upfront having more built-on partnerships and understanding better the conditions in the countries. Lesson learned also that was very important, and I think we did it from the beginning, but if I would have been doing it again, I would have done even more, is the key role that technology providers play when we want to promote energy efficiency investments. At the end of the day, these technology providers or service providers are the ones that have a vested interest to promote those investments locally and need to be supported. And in many cases, what we realize is that there is also a low capacity of those technology or service providers in terms of scale up as well. So sometimes, for example, we may have a wonderful insurance product, financial instrument, but the technology providers, for example, are not working in certain parts of a country. We had this in Mexico, okay? The technology providers we were working with were not actually working in certain areas, and the program in Mexico we started for promoting energy efficiency in the agro business was a barrier, because some of the technology providers didn't have the appetite or the capacity even to promote the technologies to go to those places. So one thing learned also was the importance of upfront understanding very well the capacities and the appetites of those technology providers so that we can build the program with them because at the end, they are the ones that are going to push in this investment. Finally, I think in terms of also lesson learned is how to involve the insurances from the very beginning, and what is the better balance of having one insurance like we had in Colombia being a champion, Suramericana, but on the other hand, maybe in other countries like in Brazil, thinking of going to a larger share of insurances so that we can provoke also some kind of competition and push the product to be better tailored. It's a balance as well. And I think, as I mentioned also in my starting point, I think our next point now is where we are at. We have some pilots that are already working. How can we scale this up so that the insurances can truly take this as a product and start developing it within their businesses? Thank you.
Great, thank you, Maria. So I see we're getting close to time. So what I'm going to ask Aditi and Itzer to do is sort of combine your answers to the last two rounds into one very briefly, just to talk a little bit about, kind of reflect a little bit about on what you've heard and how, and also, your own work, how your own lessons learned have changed your approach. And then the last question that, I had for the whole group is, if you could influence one thing in the market to help with scale up, what would that be? So there's actually some people out there who think that you can't scale blended finance, that it's not possible, that they're all too bespoke. So what's one thing you would change in the market to help with that? So let me give each of you 2 minutes if possible. Then I'm going to turn back to our three instruments just to kind of in a couple of words answer that last question, and then we'll go ahead and close. So let's go to Itzer first and then Aditi.
Yeah, thanks. Let's see. I'm not good in getting brief, but a lot has been said. So for me, maybe 5 points. One, it's new. And I really underestimated if things are new that people are anxious. So the resistance to change inside our own organization is huge. So second point, alluded to by Andrew, but also Harold, is trust. So it needs blended finance, and blended finance brings together the donor, governments, investors, development finance institutions, and we all look at the apple differently. So what for me is an apple is for another a pear. And before I really realized that, and to make sure the language you speak is the same, it takes a lot of time. And the miscommunication and why are they behaving like that? Well, in the end, everybody is rational. And so to really accept that the other points are valid and legitimate and not probably very stupid because you cannot follow, that's your own mistake. That takes a lot, at least in my psychology, to change that. So that trust element is there. Then also internally in an organization like ourselves, I think if the top person, like Climate Investor One, was our CEO who believed in it, and he really believed. And without such a belief, it will not happen. It just will not happen. The other one is focus. So I think we can only do one or maybe two things. It takes 2-3 years. So to have too many things going on, you will finish nothing. So really focus, have the purpose. And I think believe. So really believe in what you do, get it through. And also with Climate Investor One, there was a precarious moment where I stopped believing. One of the big donors fell away. So I really even said at the time, well, I don't think it will happen anymore. And that kind of valley of death in mental you will go through is normal. It will happen and you still have to continue. So maybe leave it there also considering the time.
Thank you. It's good to remember that, there was, even for the most successful, there was that moment where, it may not have worked out. Aditi, over to you.
Thanks, Bella. Maybe I'll start with reflecting on what the other panels have said and how it ties into our own research. We have done research on scaling blended finance, and in fact, we found that climate action is the one which is most ready to scale amongst a lot of the SDGs. And the question is, how do you mobilize at scale? And I think one thing that's come out from the panelists as well and consistent with our research is that portfolio approaches are preferred to standalone projects. And portfolio approaches by aggregating multiple projects can really get to the scale that a lot of institutional investors are interested in and can lead to critical mass. For investors, I think these projects take a long approval and diligence process, and it's worth it if the scale or size can be achieved on a portfolio basis. And also with the portfolio approach, you have a diversification across projects that can help with the risk return variances amongst the projects. And also on the use of blended finance itself, I think we've seen that when you are investing in climate in developing countries, it's often high risk, and you need some kind of risk mitigation or return enhancement for it to work at scale. And I think both Harold and Andrew emphasized that, and that's something we've seen. And the other thing I think is important, given that we have Harold on the panel, is the use of currency risk mitigation measures. I think investing in developing countries, we've seen currency risk is pervasive and needs to be addressed, preferably at the portfolio level for it to scale. And finally, I think what you asked around the silver bullet, and this is something we mentioned in our state of blended finance, it's hard to pick one thing, but I think pursuing standardized investments and standardized approaches aggressively is really needed for it to scale. Oftentimes there's a tension between innovation and standardization. But as everyone has mentioned, these projects take a long time to come together. You have different stakeholders that need buy-in from different perspectives. And so if there's something that's worked and if you can do it again, I think that should be the preferred approach. Or as Maria said, replicate it in different countries, or really spread the learning in the market so that the market can replicate.
Thank you so much, Aditi and Itzert. Let me hear just in 2 words from Harold, Andrew, and Maria. What would you change about the market if you could?
I assume you keep the order and me first, okay? Won't be 2 words, but I try to keep it as short as possible. It's about scale. We need to have a razor-sharp focus on scale. We need to get the terawatts. We don't need to get the megawatts, we need to get the terawatts. That means we need to focus on technologies, in my view, which are highly scalable, which have relatively low project implementation risks. And for the other non-project specific risks, we need to have an easier access to mitigation instruments like TCX, like MEGA, like ATI. So very often it's still too complex for the individual developer to access these risk mitigation instruments. We need to bundle them, make it easier accessible for the developers, and do it on the, and contrast to what we heard before, do it on the project level, because then you create relatively homogeneous cash flows, which you can then aggregate and transform into bonds. And because of this bond aggregation, you make it accessible to the big institutional investors who want to invest 200, 300 million in order to have these liquid secondary markets as well. So that's my wish.
Thank you, Harold. Andrew, what's your wish? Andrew, are you still there? Oh,
yes, yeah. Yes, I am. Okay, so my wish would be to put climate finance on a war footing. I think that the overlay of climate on everything that has gone before, that is the tendered emerging market financing and infrastructure financing, and now overlaid with a objective of climate financing, is adding further complexity to something that's already complex. And we just got to look at the deficit of infrastructure financing in emerging markets to recognize that old models have been too slow. So I think putting climate financing on a war footing that gives it 4 or 5 key objectives that would mobilize and put urgency behind the battle that we actually are fighting at the moment in respect to climate.
Thank you, Andrew. Maria, last words?
Well, I think partially the same. I think it's important to think how we can better use the blending to accept that there could be mistakes and that things that to be scaled up, we can accept some simplifications as well. You know, our lesson learned is you cannot be perfect on everything. We don't need to deal, for example, with all the technologies or very complex approaches, for example, on energy efficiency. We can be able to promote maybe the most important technologies, and by dealing with this package, do something. And also understand that probably when you use these blended resources, the idea is that some part of it will work very well and maybe part of it will not, because you need time for those things to take place. So certainly I think we should not overcomplicate, we should actually simplify and promote this kind of scalable approaches, you know. The other thing I think in terms of markets, in my case, I think how can we promote more dialogue on concrete products, for example, with insurance markets, that can be a bit of the traditional comfort zone of those kind of players. Is there a way for us to have ways to promote these better? If I would provoke CPI, I think that's something we should start thinking of, you know, beyond just incubation of the product itself. Can we have a conversation with different types of market players on how we can provoke them as well to think a bit beyond just the business as usual, no? So in terms of sustainability over the future as well. Thank you.
Great, thank you so much, Maria. So from the panelists, I heard simplify, prioritize, trust, be tenacious, a lot of other really rich things that you've said today. Really thank you all for your time. Apologies for going a couple minutes over time. I've certainly learned a lot, and really applaud again all of the panelists for all of the hard work that you have been doing to make climate finance and scaling up of climate finance a huge priority and a reality around the world. So really, thank you all so much. Rob did put in the chat a link if you are interested more in the lab. We actually have a call for ideas open until December 22nd if you have your own climate finance idea. But really, thank you all so much for all of your time, and really hope that this is the start, or part of a broader conversation on scaling up of blended finance and climate finance instruments, and really hope to continue to engage on this as we move forward, and really, as Andrew said, kind of get on that war footing and really really make this happen over the next 5 years or so. So thank you all so much, and have a wonderful rest of your day. Happy Thanksgiving to everybody in the US, and we'll see you all soon. So thank you.
And thank you to CPI and the staff. Thank you very much. You guys are doing a great job. Thank you.
Thank you so much for the opportunity again. Thank you.
All right, bye-bye.
Cheers all.
Bye.
Have a good day.
Thank you.